Welcome to the Capital Employed podcast. In this episode, I had the pleasure of talking to Theron de Ris from Eschler Asset Management. In this episode, Theron provides an overview of his fund and investment style. He also talks about two stocks from his portfolio that he's optimistic will perform well over the forthcoming years. I really enjoyed listening to him, and I think you will too. Before we jump into this episode, do make sure to add your email to the Capital Employed email list. We will be publishing some exclusive interviews that will only be available to those on the list. To receive these bonus episodes, please visit capitalemployed.fm/exclusive and add your email to the list. Okay, on with this week's episode. Please enjoy my conversation with Theron. Hi Theron, thanks for coming onto the podcast.
My pleasure.
Can you provide an overview of your fund and what the investment style is?
Sure. And John, thanks for having me on your podcast. Eschler is a private partnership I founded about a decade ago to manage my own and third-party capital. And perhaps just a quick note on myself. Before I launched Eschler, I got a career at a couple investment banks under my belt here in Europe. And it was, a reasonably exciting adventure, but it was also sort of a safe path. And I think that was a reaction to a lot of financial insecurity growing up. Halfway through my career, that is to say, 13 years into my career on the sell side, I began to really kind of appreciate, why my dad had been in business for himself. And it wasn't about the money. It was really about having control over his time. And so, in going out on my own and setting up Eschler, it really wasn't about the money for me, but really about doing what I enjoyed with my time and investing the way I wanted to. So if we fast forward to today, we're a team of three at Eschler, myself as the portfolio manager, our chief operating officer, John Price-Robertson, and Matthew Anthony, who runs business development. And I manage a long-term, concentrated, value-oriented equity fund. And we also host half a dozen managers who run primarily long-biased absolute return strategies on our AIFM platform. And collectively, we have about just over $500 million in assets under management. From a mission perspective, we really cater to three constituencies. First would be nonprofits, endowments, et cetera, with a perpetual time horizon that are really looking to grow real wealth. And my fund has returned in about 8.5 years, about 1,000 basis points over inflation net of fees. That's, I think, well in excess of what these clients target. And so I'm quite excited by our potential to grow in this segment. Second, I'd say, entrepreneurs who have built wealth in, for example, concentrated technology investments or private equity or growth investing in this recent financial cycle. These are clients who share our long-term philosophy, but I think we can help them achieve diversification by providing a more liquid, value-oriented strategy with more of a focus on real assets. And then the third, as I alluded to earlier, are startup independent managers looking to get off the ground, like me 10 years ago. I have a bit of a soft spot for emerging managers, and I really do enjoy helping them navigate the startup process. Just briefly, in terms of investment philosophy, the main idea, John, is that the market is there to serve us. And so I want to be able to take advantage of the volatility created by its moods to buy assets at less than what they're worth. And then, obviously be patient, wait for the thesis to materialize, and then, not sell them too soon as well. And, I guess in the value tradition, I've tended to invest a bit early, then kind of tread water and then get paid later. So that was the case in, 2014, 15, and 16. Where the fund treaded water for 2 years and then was up a lot in 2016. And that process repeated in 17, 18, treading water. And then the last couple of years have been great. So I guess it's the old quote from Shelby Davis, you make most of your money during a bear market. You just don't know it at the time. Lastly, I'd say, how we deploy the portfolio is worth mentioning. I think it sets us apart a bit. The fund is really kind of a hybrid between a traditional long-only strategy and a long-short strategy. So, unlike the, a value fund, just a traditional long-only fund, we do have the option to modestly hedge the portfolio. We don't exercise it much, but I'd say it's an extra arrow in our quiver. and can and has, frankly, added value. But unlike a long short fund, we're not just targeting low volatility. Instead, the objective is really to have full cycle, net returns above the equity market, and tolerate market like volatility. And so I think that's what allows for the upside optionality in the strategy.
And is there any particular industries or sectors you focus on?
Sure. I think where we're a bit different from a lot of funds investing with a value philosophy is where we tend to fish for ideas. And I've found some success in recent years in more cyclical industries. And as a general rule, I'd say value managers tend to shy away, for good reason, frankly, from for example, commodity industries. My insight there is that you can still these are still industries where you can actually still rely on reversion to the mean, and you can use a normalized earnings approach, and that isn't the case in some other sectors where you've had such profound change. So those are proper value principles, but you do have to have a strong nerve. I think many investors are dissuaded, and so competition's a bit lower. In terms of, I guess, the company characteristics I'm looking for, it's strong balance sheet, above average earnings power, sort of normalized on a normalized basis, and then a management team with skin in the game. But if I could, to pick maybe one business characteristic I'm interested in right now, it's probably an ability to withstand inflation. And it's something I've thought a lot about in recent years. It's very rare. The way governments are now applying stimulus, really putting money in people's pockets is quite different, right? So it makes me think the money will now actually get spent in the real economy instead of sort of just sloshing around the financial markets. And I think it's that increases the potential for more sustained inflation. And I think investors are waking up to this, but I don't think many are positioned for it. So that's a big focus for how I'm constructing the portfolio. So what are the types of companies that could withstand inflation? I think the conventional wisdom is that you want to look for companies with with a moat and pricing power and whatnot. And I think that's sort of obvious and probably priced in. Over the next couple of years, I think my hunch is that more deep value stocks can go from having no pricing power to just a little bit will do really well because that's not priced in. They'll be growing their earnings faster than growth stocks, at least temporarily. You could also invest in businesses involved in mineral extraction. The problem there is you have high capex and exposure to quite a bit of cost inflation. So you give up some of the operating leverage that as an investor you would actually seek. So one segment that fits this inflation theme that I'm thinking about a lot within the minerals area that I find interesting is royalty businesses. And I'm not sure how familiar you are with them, but basically the model is, in a nutshell, you get the upside from price inflation, but you have very low fixed costs. So you basically keep your margin.
So if we can jump into your portfolio, can you talk us through maybe two companies that you feel have good potential upside over the forthcoming years?
The first stock is called EMX Royalty, and the ticker is EMX, trades on the New York Stock Exchange. The company has about 92 million shares outstanding, trades just over $3 a share, and has a market cap of about $270 million. They have about $54 million in cash and no debt. And they have that cash because they've exited successful investments, not because they've diluted shareholders. As the name implies, EMX owns royalties on precious metals, copper, and other sort of battery metal assets. And what I like about this company is really the business model and the management. If you look at the precious metals industry, most of the big money historically has been made through exploration. And EMX is really a team of geologists who basically, what they do is they hunt for mineralized properties. They're good at identifying them. They stake the land on the cheap, and then they develop it, or at least they get it to the point where they can sell it or option these rights, mineral rights, to third parties in exchange for shares in the companies, royalties, option fees, etc. So basically, they get other companies to spend money on their properties, which is a good business model. And for a company of its size, EMX has assembled really an unmatched inventory of mineral rights. I think they have like over 3 million acres worldwide. For example, they're one of the largest owners of mineral rights in Scandinavia. They have big positions in Arizona, Nevada, Serbia, Turkey, Australia, Chile, etc. It's a very global company. So anyway, this model based on generating organic royalties is quite different in my view compared to many of the new entrants in this business. It's a very attractive business, so it's attracted a fair amount of competition. But these new entrants are primarily involved in competing to buy existing royalties at often subpar returns. In terms of the management of EMX, the CEO is a geologist by training, and he's also very shareholder focused. And I guess that's sort of a rare combination. The insiders own about 15% of the company, and they've sort of proven they can invest countercyclically, which is valuable and necessary in this industry to drive value. So the near term upside for the company is basically there are a couple of royalties will be entering production this year or next. One is a polymetallic zinc lead silver asset in Turkey, and the other is a gigantic copper asset in Serbia where they have a small royalty, but it really adds up as this thing comes into production for this small company. Longer term, it's really hard to know exactly where the value will materialize, but the breadth of their portfolio, I think, gives this company a lot of optionality, and that's why you invest in royalty companies. In terms of the valuation, it is less undervalued than it was, a year ago. But I can get to the current share price just by valuing the two royalties I mentioned, plus their existing gold royalty in Nevada, the cash, and putting a very modest value on their global mineral rights, just the land. And so this kind of leaves the potential for plenty of good surprises over time from the rest of the portfolio. I'd be remiss not to mention the risks here. This is a resources company. So if metals turn down into a bear market, this company will not be spared. They won't go out of business, though. It's a strong, pretty asset-light business in terms of fixed assets. And so I think over the long term, the company should be able to build and retain shareholder value. So that's the first idea. I'll just give you one more. The company is called Pzena Asset Management. The ticker is PZN. Also trades in New York. The company has about 71 million shares outstanding. Trades at $10.60 per share. Has a market cap of about 760 million. I actually can't find any analyst coverage on this company, which is kind of interesting. But as the name implies, Pzena manages assets for third parties. They specialize in value investing in, I guess, what you'd call more the traditional mold. The company has about 46 billion in assets under management. So they're large by the standards of emerging managers like myself, but small compared to the scale that's required in asset management industry, I guess. They still have very high pre-tax margins. About 45%, and of course they're quite asset light. Their assets being the employees and analysts. So it's actually a very simple investment case, John. I think the company is basically in the right place at the right time. They have a strong culture. It was founded by the ex-head of research at Sanford Bernstein, Richard Pzena, 13, 14 years ago, and they have a dedicated value philosophy. And I just think that as the tailwinds for value continue to increase, Pzena's net flows will improve, and that's really the key driver for stock performance in this industry. And their net flows have been kind of stable, which under the circumstances is not bad in recent years. Like EMX that I just talked about, the shares are not as undervalued as they were, back about a year ago. Well, June, July of last year, they were trading at 5 times trailing earnings. Now they're more like 10 times. But it's not too hard for me to get their current asset under management level run rate, about $1.20 in pre-tax earnings power. I think that puts fair value for the shares, closer to the mid-teens. And historically, Pzena's portfolio returns have averaged about 10%. So they've actually done pretty well, even though it's been tough for value. And that's with stable margins, and they've also paid a lot of that out to shareholders. So I think over the long term, the company can deliver decent low double-digit returns, and it's somewhat undervalued today as well. The risk here, again, clearly any setback for the value style, would impair the company to some extent. institutional investors can be quite fickle if they were to underperform their benchmarks as well. And of course, a broader market sell-off would clearly hurt these shares. They are quite market sensitive.
It's got a very good attractive dividend yield as well.
Yeah, I mean they didn't have to, but they did cut their dividend last year. But
I see.
The business has already recovered. In fact, it was never impaired. And like many British companies here who cut their dividends kind of as a knee-jerk reaction, they'll be reinstating their normal payout policy. And yes, the dividend will be quite attractive going forward.
Thanks, Theron, for sharing those two companies. Yeah, they both look very interesting. Are you a keen reader of books? And if so, have you read any book recently that you really enjoyed?
I don't read as many books as I used to. I think I probably speak for many people in that regard. I get quite distracted by social media and other sort of shorter form ways of consuming content. But I've just been reading a book called it's fictional called Assassin by Doug Casey, who you may or may not have heard of. He's sort of a maverick investor, libertarian entrepreneur, etc. And anyway, the book deals with an interesting subject, basically the morality of political assassination of basically very, very bad people. The lead character is this guy called Charles Knight, and he's sort of this lone wolf pitted against the deep state. And it's actually the third book in a trilogy. The first book is called Speculator, and the second is Drug Lord, and they're all real page turners. Actually, Speculator is probably the best of all, the first one. So those are good reads.
Thanks, Theron, for coming onto the show. Where can listeners find out more about your fund and yourself as well?
So they can sign up to our fund portal, and you can go to our website and just go to the fund portal tab and request access. And if you're a professional investor, then you can learn all about our fund on our fund portal. We also have some information on our website at www.eschlerasset.com. We also have a YouTube channel with a few things on there where I talk about my philosophy, process, etc. as well. And then I'm also on LinkedIn.
Okay, that's brilliant. Yeah, thanks, Theron, for coming on. It's been a pleasure having you on. Hopefully we can get you back on again later in the year.
I'd enjoy that. And again, thank you for the opportunity to speak with you, John.